Hi, I'm Marianne Yanka, a senior commodity consultant at Total Farm Marketing, and welcome to Market Basics. I've been in agribusiness for 30 years as an originator, elevator manager, and for the past 16 years as a market advisor helping farmers sell their crops. And I've seen over the years that it's very common for producers like yourself to not really understand how futures markets work. You feel like you're powerless, can't beat the market, and they always win. But they have the same opportunities as you. They just understand how the markets work and have a plan. And you can too. But first, you need to know what the market is. In these videos, we're going to break things down into the very basics so you can get a good understanding of what makes up the commodity markets, why they do what they do, and the tools you can use to take advantage of opportunities when they happen. But first, what are commodity markets? The market is a generalized term for the exchange where commodity futures contracts are traded. The activity that takes place on the exchanges and even refers to the participants as a whole that are involved in the activity. Corn, soybeans, and wheat are traded through the CME group. Trading is conducted in two methods: an open outcry format, which look like this, traders arranged in groups called pits using hand signals and yelling all over each other to conduct trades. And from the outside, this looked and sounded chaotic, but was a very efficient process since 1848 when the Chicago Board of Trade was organized. Then in 2006, the CME Globex trading system was launched. This is an electronic trading platform. More than 90% of transactions are done electronically, almost 24 hours a day and from all over the world. In 2019, CME Group's non-US average daily volume reached a record 4.9 million contracts. The main thing is that regardless of the exchange or platform, the contracts are standardized and backed by the exchange. So let's look at the contract. What is a futures contract? It's an agreement between a buyer and a seller of a specific quantity of something at a set price and date in the future. Commodity futures can be used to protect or lock in the price of an asset, called hedging, or to bet on the direction the price of that asset will move. That's called speculating. The exchange platform brings together a buyer and a seller. For every contract that's traded, there's a buyer and a seller. They agree on the commodity, the delivery date, and the price. No physical corn, wheat, or other commodity has changed hands. That's it. It's just a contract for in the future. The buyer thinks the price can go higher, the seller thinks the price can go lower, and they want to lock it in. So who's doing the trading? Who are the market participants? Who is they? Well, to start with, farmers like you, grain elevators and processors, businesses connected to the physical side of the commodities are called commercials, and they make up a large part of the market. Then there are non-commercials like hedge funds, institutional traders, like the big banks and investment firms. There are also small speculators who trade for themselves and typically hold their positions, more on that in a minute, for a little while. These aren't all of the different traders in the marketplace, but all participants make up the daily trade as they are all exchanging the same futures contracts as you. When a participant or trader buys or sells, they're taking a position in the market. When they buy, they're getting long. And when they sell, they're getting short. A farmer might get short to hedge the corn he has in the bin and still needs to sell in the future. And an investment banker might get long because they think the price will go up sometime in the future. Okay, so what you really want to know is, what everyone wants to know, is where a price is going to go. Everyone has opinions on the market. Everyone wants to try to figure out how far prices will move up or down. Price fluctuations caused by geopolitical risk, supply and demand, weather, etc. The volatility gives you bigger moves. How to gauge all this is like trying to measure emotions. Some of the answer is in the name. Futures market. Market participants are always looking ahead and trying to guess what is going to happen in the future. Will there be a big corn crop? Then prices will go lower. Will there be a war in the Middle East? Then oil prices will go higher. But as the market is seeing an event unfold, it's trying to measure the extent this will have on the ending price in the future of a specific contract. New crop corn will mostly affect the December futures. Oil prices next summer, the July crude oil contract. If in a drought, ultimately there will be estimates for very low yields. That pushes prices higher. But those yield ideas will probably get too low and the prices will go higher than it needs to go to curb demand or facilitate imports to help ease supply and demand imbalance. If we have an economic issue and traders start to liquidate all their positions, we can see prices move down quickly. Or if we have a trade war, that could push prices lower or keep them in a stagnant range as those problems are worked out. So when there's a drought developing, for example, more people want to buy or get long than want to sell. Whenever there are more people that want to buy something, the price goes up. That is also referred to as a rally or a bull market. On the other hand, if there's a financial crisis and traders want to get out of their positions to limit risk or to get cash, there are more people that want to sell. This puts pressure to the downside because the few buyers can force the sellers to take a lower price. This is also referred to as a bear market. When this outpacing is pushing the market, it causes a trend, and how aggressively or slowly the trend develops is often called momentum. Market momentum is a measure of overall market sentiment. Traders will use analytical tools to try to measure sentiment. Basically, all technical analysis is a way to try and measure emotions. This chart illustrates the typical cycle of emotions a market will go through during a rally and sell-off. As the market is moving higher, stories get more bullish. Traders get excited by the possibility for higher and higher prices and ultimately think prices will go higher than even imaginable. And suddenly the atmosphere changes. Maybe it rains or end users start buying their needs from other countries. Whatever the cause, buyers or participants that were long start to sell to exit their positions. The market starts to feel a little anxious that the top is in, but it'll bounce back. But then it continues to slide. Traders start to panic. It has to bounce back. Don't they know that there was a drought? But finally, they find that the drought didn't hurt yields as much as people thought, as it would back here. And that's called capitulation. The participants that are still long lose all hope that the market will recover and throw in the towel and exit their positions by selling. When the last of the selling pressure has dried up, buyers, maybe speculative, come back in trying to make a profit and the whole cycle starts again. If you can be positioned long or short before emotions swing the other way and all the buyers want to be sellers or all the sellers want to start to buy, you can gain from it. It's very hard for a producer to hear about withering crops in the field and have the discipline to pull the trigger or not throw in the towel when the prices seem destined to go lower, or when prices just keep dropping to believe that they will ever go higher again. But that's precisely what it takes and makes the difference between good marketers and bad marketers or traders. Sooner or later, rallies and sell-offs run their course. You have to be able to take emotion out of the decision-making process. That's why so many trading firms use computer programs to give them buy and sell signals. If you can sell when everyone says the price is going higher or buy when no one expects the prices can go higher, you too can take advantage of the volatility and price swings in the market. Take, for instance, the 2016 corn market. In the spring, farmers were expecting to plant more corn acres than in the previous 4 years, and there was already an increasing supply. So we saw a sharp sell-off right after the March acreage report. But when the weather turned hot and news headlines started to talk of another drought, prices started to move back higher. But eventually the weather improved and the market sold off, and we found that at harvest, We had a record crop, but then that pushed prices further than they needed to go. As talk increased about prices going back to those seen in the 1990s, and the increased selling pressure pushed prices much too low. Speculators came back in, and then end users, and the market recovered. There were opportunities that year if you were able to take emotion out of the marketing of your crop. So in this short time, we've covered a few industry terms you now understand and can expand on that, and with the help of your advisor, begin to use the commodity markets with confidence. Hopefully this has helped answer some questions about what the markets are and why they fluctuate like they do. In our next video, we'll show how you can use futures contracts to better market your crops. Still have more questions on using futures? We're here to help. Talk to your advisor.